Thanks to Jim and Avner for putting together another great Utah Winter Finance Conference. It's been a pleasure to be here. Thanks for having our paper. Now that I'm going home in one piece, I have good hopes that my wife will let me come back in the future. So looking forward to that. So this is joint work with Paolo Sodini, Roine, Vestman, and Ulf von Lilienfeld-Tolln, all of whom are in Stockholm or were in Stockholm. And as the title suggests, this paper is a household finance paper studying the benefits from home ownership. So the motivation for this paper is really quite straightforward. Lots of countries, the emerging markets as well as developed countries, are spending an awful lot of money on promoting home ownership. They do this in a variety of ways. Think about the mortgage interest deductibility, think about exemptions of capital gains taxation for primary residences, exemptions of basically imputed rent. In the US, for example, this costs about $200 billion a year. That said, this is a very uncontroversial policy, both on the left and on the right. Everybody agrees with kind of the political imperative, I should say, of subsidizing home ownership. And in this time of rising income inequality, home ownership is often referred to as kind of that last straw that the middle class has to hang on to. And in that sense, kind of the decline in home ownership in the U.S. has caused alarm in some quarters. Now, despite kind of the alleged importance of home ownership, we actually have very little solid empirical evidence for the benefits of home ownership. We have anecdotal evidence, and in particular, I think there's two benefits that people often point to. The first one is this kind of idea of forced savings. If you buy a house, it's a commitment device to save. First, you save for a down payment, and then later, as you pay off your mortgage, you accumulate home equity. The second one is the role of housing as a collateral asset. When you have a negative income shock, to have this big asset and the ability to draw against that home equity would allow you to buffer that income shock and allow you to smooth your consumption over time. Right? So those are the kind of benefits that we're going to be exploring in this paper in particular, these individual home benefits from home ownership. Now, we've learned in the financial crisis that there's downsides to home ownership as well. Right? People who got too deep into debt when house prices collapsed, they were not able to essentially pay off their mortgage. That pushed them into foreclosure, which had kind of lasting implications for their credit and so forth and so forth. Another benefit of homeownership that this paper is not going to speak to, but we hope to address in a future follow-up study, are the social benefits from homeownership. People have pointed to all kinds of positive externalities, from bigger involvement into the community to voter participation to a reduction in crime associated with homeownership. The problem with all of these benefits and costs is that they kind of suffer from a big endogeneity problem. People in this literature, in the 80s and 90s would typically run regressions of, for example, teenage pregnancy on home ownership. And they would find that higher home ownership rates are associated with lower teenage pregnancy. But what can we conclude from this if kind of an omitted variable, let's say wealth or income, is driving both teenage pregnancy and home ownership, right? So addressing this endogeneity problem is really kind of what has held this literature back. And there's kind of really two sources of endogeneity. One is that tenure status, owning versus renting, is endogenous. And the second one is that the types of buildings that are being owned are quite different from the types of buildings that are being rented. Multifamily versus single family, urban versus suburban. And ideally, we'd like to run a natural experiment, but for obvious technical, fiscal, and even ethical reasons, that's kind of a hard thing to do. And so there's essentially very little experimental evidence that would allow us to kind of cleanly identify these benefits from homeownership. There's a couple of papers of like 12 guys in Baltimore that got a small contribution towards buying a house, and then they were asked in a survey later whether they felt any happier. Right? So there's not a lot of evidence out there, and this is where this paper comes in. We're going to be basically having a quasi-natural experiment whereby a large group of people got the opportunity to buy their rented apartment and become homeowner. The experiment takes place in Stockholm between 1999 and 2007. And this is, we want to argue, not kind of an isolated incidence of such experiments. In the UK under Thatcher, there were similar large-scale privatizations more recently in Germany, in the Netherlands, in Hong Kong. We have our data has certain advantages over that earlier literature. It's much larger. We're going to have about 5,000 households in our sample. We have a nice panel dimension where we can follow these people from about 3 to 4 years before they got this opportunity to buy their place to 4 to 5 years after. And most importantly, we have excellent quality data for these people because we're able to match up the people who lived in those apartments with their tax records. And as a result, we know everything about them. We know every stock they hold, every bond they hold. We know every source of labor income. We know their demographics and so forth. We also now have a lot of data on dwelling characteristics at the unit level from these landlords. And so I should say up front that our study is going to study both the economic implications of home ownership per se, as well as a windfall that was associated with this conversion. Right? So in particular, these people were able to buy their place at what we're going to argue is kind of a discount from the price of owner-occupied apartments. And we want to argue that this is in some sense a feature rather than a bug of the experiment, because any policy that stimulates home ownership is going to be associated with a windfall. It's always going to be a subsidy from taxpayers to homeowners. And even absent the subsidy, once you become a homeowner, you're going to be exposed to house price fluctuations in either direction afterwards, which you can also think of as a windfall. Right? Now, that said, we're going to try to decompose basically what part of it is a pure homeownership effect versus the windfall by exploiting the fact that there's a lot of heterogeneity in the size of the windfall in our sample. We're also going to be studying marginal propensities to consume out of exogenous increases in housing wealth, as well as a collateral effect. So what do we find? So the first finding is that our experiment has large and persistent effects on home ownership. Giving these people the opportunity to buy their place, we see that 4 to 5 years later, the vast majority, 8 out of 9, are still in the same status of home ownership. Even though they had the opportunity to essentially flip the house, realize the windfall, move on, return to rentership, only 1 out of 9 does so. So we conclude from this that homeownership is some sort of desired status for these people. Second, we're going to study consumption and savings. That's kind of our main outcome variable. And in the first year in which they become a homeowner, what we see is kind of a puzzlingly large drop in their spending. And what they're in fact doing is they're making a down payment on this house. For reasons that I'm going to show you later, they did not have to make any down payment. They voluntarily make a down payment. Right? So they basically choose to save in the form of making a large down payment, and as a result, their consumption drops quite dramatically. So this at least flies, prima facie is kind of evidence against consumption smoothing, we would argue. More importantly, in the years after home ownership, we find actually very weak responses of consumption. Right? So we don't find that these guys are now all of a sudden consuming big time out of their housing wealth. In fact, there's a lot of interesting heterogeneity along the dimension of guys who decide to move, to basically sell that apartment and move somewhere else. Those are the ones that realize this windfall. We see them spend fairly substantially out of this housing wealth, in contrast to the guys who stay put, who are still in that same apartment at the end of the sample when we observe them. These guys barely spend at all. In fact, they behave like the kind of savers that we have in mind when we're thinking about this kind of commitment device of saving, where people are just gradually paying off their mortgage and saving in the process. We also find evidence for a strong housing collateral effect. We're going to look at people who suffer a bad income shock, 25% or more, and we find that those who exogenously became homeowner are actually going to borrow in the face of that income shock and are going to fully offset that kind of decline that otherwise would hit their consumption by borrowing against their home equity. We also look inside the savings decision at kind of risky asset allocation, and maybe surprisingly, we find that homeowners actually are going to participate more in stock markets and are going to allocate a larger share of their financial portfolio to risky assets, to stocks and mutual funds. And finally, we're going to study mobility, and we're going to find that homeownership, maybe again surprisingly, increases mobility, kind of consistent with a housing ladder effect, where people who kind of become homeowner now can use the capital gains that they realize when selling their first house to make a down payment on a larger house and move up to nicer neighborhoods, to neighborhoods with higher income and higher house prices. Okay, and then as I suggested, these results hold across the windfall distribution, suggesting that they're more of a pure homeownership effect rather than an effect that increases, for example, in the size of the windfall. Okay, so let me now start by giving you a little bit more institutional background to help you better understand the nature of this experiment. So some of this will kind of help us think about kind of the context in which this takes place, which is in Stockholm. So in Stockholm, there's these 3 municipal landlords who collectively own about 110,000 apartments, about a third of the rental stock. And this kind of dates back to Sweden was a socialist society for a very long time. In the 70s, there was this Miljon program, which kind of aimed to provide high-quality housing for low working class and middle-income people for 1 million Swedes. And kind of all these buildings that we're talking about were built as part of that experiment. And so kind of fast forward to 1998, after decades of socialist government, a right-wing party comes to power in Stockholm. And part of its political platform that it ran on was to privatize these, or at least a substantial fraction of those, municipally owned apartments. Right? So this was a political decision to kind of try to convert some of those apartments that were renter occupied into owner-occupied properties. And over the next 6 years, about 12,200 of those 110,000 apartments get converted. Now, in April 2002, the socialists get back into power, and they want to stop this privatization wave. So they pass this law, which is called Stopplag, which literally means stop law. And as the word suggests, they were trying to halt this privatization waves. They couldn't ban them, but they tried to basically put in additional layers of bureaucracy in place to kind of at least slow down this privatization process. And it's the passage of that law that's going to give us random variation in which buildings ultimately got approved for privatization and which ones did not. So here's how this privatization process works. Suppose you live in one of these buildings. You're going to get together with the other tenants. You're going to form a co-op. You're going to register as a co-op. And then you're going to petition your landlord to acquire your building. Okay, this landlord is going to have the building appraised and is going to make a take it or leave it offer. You're then going to have to come up with an economic plan that shows how you're going to finance the purchase of this building. You're probably going to get a mortgage at the level of the co-op. And then essentially, you're going to vote. And if 2/3 of the tenants or more approve this privatization, you're going to tell your landlord, we want to buy our building. The landlord is going to verify the validity of the vote, and the privatization will go through. Now, at that point, both parties have agreed, you'll sign the contract, and the building gets transferred. It's important that you're not buying your individual unit, the co-op buys the building as a whole. Now, that's how it worked until April 1st, 2002. After April 1st, 2002, because of this stop law, an additional layer of approval was put into place. There was some committee called a county board, and this county board essentially had to verify whether this privatization was going to have the following effect. So, to kind of understand this, let's take a step back and ask, how does the rental market in Sweden work? It turns out there's no such thing as a private rental market in Sweden. You cannot choose the rent of your apartment, even if you're a private landlord. In fact, for every type of apartment, in every geography, and for every quality level, there is a set rent. Okay? Whether you're a private or a municipal landlord, that's the rent you have to charge for your tenants. Okay? And what determines the level of that rent is the rent that the municipal landlords charge on those types of units. And so the idea of this county board approval was, let's verify whether the proposed privatization would get rid of so many units in the municipal landlord inventory of a particular type that we no longer have this yardstick, this reference point for setting the rent on that particular type of unit. This is, of course, a bogus argument because that rent is just made up. But this was a political ploy in order to kind of stop and slow down this privatization. And it worked in the sense that, the approval probabilities, which used to be 50 from step 1 all the way to step 7, fell from 50% to 17% after April 1st, 2002. Okay? Now, to show you just kind of one example of kind of the arbitrary nature of those decisions, let me show you this example of Akalla. So Akalla is a suburb in Stockholm, and there's these 4 co-ops which are shaded, which are colored on that left picture in red and in blue. The red ones eventually did not get privatized, the blue ones did. They're next to each other, they're built in the same year, owned by the same landlord, they have the same type of tenants, they're literally co-located. And all 4 of these buildings go through this approval process at roughly the same time. They all contact the same landlord, all these buildings get appraised in the same few weeks, they all vote by about the same margin. The landlord approves all of them in the same week, and then but unfortunately that approval happened after April 1st, 2002. So this approval is subject to this additional layer of county board approval. And so the county board rules on these 4 cases in the same meeting on February 21st, 2003. And basically what it says is all 4 of these buildings have these kind of, I don't know whether you guys can see this very well, but they have these kind of low-rise units in the courtyard. You see these little buildings here? Those actually make up a very small fraction of the overall footprint of these complexes, but they're kind of unique in the sense that, if we were to privatize all 4 of these buildings, there wouldn't be any courtyard units, low-rise courtyard units left in the municipal landlord's portfolio. And because that's the reference point for setting the rent on those type of units, the county board decided not all 4 of these buildings could get privatized. But 2 of the 4 could, because that would leave enough units. And so basically, which 2? Well, there was no law, there was nothing to go by, so they essentially flipped a coin. They went by the date of the vote. Had they gone by the fraction of the vote, had they gone by the date of first approval, we would have had 2 other buildings privatized. Okay, so I think that's a good example. So all the buildings in our sample are like that. We read all the minutes of those county board meetings, and it's always kind of the same type of argument. Now, this experiment has a couple of other nice features. So first of all, the people who get to buy their building at the net present value of what the basically at the value that the landlord assigns to this building. So this landlord earns the net present value of regulated rental income minus expenses, and that's the price. Because this was a politically motivated privatization, that's the price at which the co-op can acquire that building. That price is far below the price at which you could then turn around and sell that apartment in the private market. Why? Well, because there's scarcity of owner-occupied apartments in Stockholm, right? This is kind of a dense urban area, like so many other cities like that. There's just kind of restrictions on supply that kind of cause that windfall, if you like. So this windfall was not small. It's about $50,000 per adult, $72,000 per household. Now, of course, this tenant gives up the regulated rent when they agree to this conversion. Now, one interesting implication of this conversion is that essentially it doesn't change your monthly cash flows. Before you were paying a regulated rent, afterwards you're paying dues to the co-op and your personal mortgage payment. Those 2 quantities were about equal to each other. There's also no issue of binding financial constraints, which is a very nice feature of the experiment. Because that building was basically bought at a discount, you could easily get a mortgage for 100% of what you actually had to pay, right? So 80% loan-to-value mortgages were freely available, but the point is that the conversion fee is far below the value in the LTV. So you could easily get a 100% loan-to-conversion mortgage. Okay? So basically, we're going to be combining data from Statistics Sweden, from these municipal landlords, and from the county board's decisions. So we end up with a sample, which is basically the universe of all the buildings that were affected by stoplock, which is 46 buildings. Ultimately, 13 of these were approved, and 33 were denied. The denial group is going to be our control group. The approval group is going to be the treatment group. These buildings are similar in terms of physical characteristics. They're also similar in terms of tenant demographics and socioeconomic characteristics, as this kind of 3rd column indicates. Just to kind of assuage any fears that this is some sort of weird sample of households that live in this like public housing, that's not what it is. These people look very similar to a much larger sample of co-op conversions, most of which were not subject to stoplock. And in fact, they look similar to all Stockholm renters. Okay? So for example, this is the income distribution in yellow in our sample. It fits comfortably in the body of the Stockholm-wide income distribution. So our approach is going to be to basically look at a bunch of outcome variables, in particular consumption and savings, for the guys who got this opportunity to buy their house, and contrast them with the guys that did not, right? This control group of people that were essentially denied privatization. So this is a standard dynamic difference in difference specification, where this variable convert is 1 if you got the opportunity to convert. This is an intention to treat estimation, because not everybody who got treated, the treatment here is the option to buy your place. Not everybody actually exercised that option. But about 93% of people did. So the treatment of the treated effects are going to be just a little bit larger than the ITT effects that I'm going to show you. Okay, we control for year and building fixed effects. And for presentational purposes, I'm going to essentially collapse the pre-period into one term, and then the post-period, I'm going to break out the year of conversion separately. All right, so the first thing that we look at is just home ownership itself. Do people actually exercise their option to buy their apartment when they're given the opportunity? And the answer is absolutely, right? So 93% of the people do, and so you see a large spike in home ownership. And more importantly, this spike is persistent. It's true that there's a little bit of attrition in the sense that some of the people who bought their place then later decide to sell it and revert to renting, but the vast majority stays in home ownership. It's also true that the control group who did not get to buy here, some of them eventually buy, but very few of them do. So the gap between the treatment and the control in terms of homeownership, even 3 to 5 years later, this is 3 to 5 years later, is still massive. It's still more than 60%, right? So kind of by revealed preference, homeownership seems to be like a desired status, and you know, this experiment has very lasting implications for homeownership. Our main reason, yes.
You have to pay capital gains if you sell?
Yes, yes. That's what I was referring to when I used this word windfall. So our main table is this one here, 10 minutes, okay, where we look at consumption and savings, right? And so the first row shows you those pre-period effects, and essentially we have parallel trends before this experiment starts, which is a good thing. And then in the year of privatization, what we see is a large consumption drop for the treated group, for those who become homeowner, relative to the group that does not. Okay, so this is a 16,000 krona. So think about, you know, all the krona numbers, you should divide them by 10 roughly to get them into dollars. So that's about $1,650 per adult. There are about 2.7 adult equivalents in a household. So that's about $5,000 consumption drop. So this is a massive consumption drop. Where does it come from? Mechanically, consumption is income minus savings. So income actually increases by about 11,000 krona, which is about an 8% effect relative to the pre-treatment average. Of course, these people buy their house, so you expect to see a large increase in their housing wealth. They finance that largely through a mortgage, so you see a large increase in their mortgage debt. And you know, they basically dissave a little bit in terms of their financial assets. Their bank accounts go down a little bit, and maybe they sell some stocks and some bonds. Right? So as a result of those last three terms, their savings go up by 27,000. So there's a large increase in savings in the year of privatization. And we want to argue that's at least a little bit puzzling. Why? Well, because, you know, so essentially what's happening is these guys, they get more income, but then they make this large down payment on their house, 39,000 krona down payment, which is not, you know, not at all offset by a decline in financial wealth. So why do they do this? We argue they didn't have to make this down payment at all, because they could have easily gotten a larger mortgage instead. So they voluntarily make this down payment. And you know, why could that be? Well, there's a couple of rational reasons why that could be. For example, when you make a larger down payment, effectively you're earning the mortgage interest rate on that. And so if you perceive that earning the mortgage interest rate is better than earning what your alternative rate of return on your financial portfolio might be, that could be one reason why you want to make a larger down payment. Alternatively, it could be something like debt aversion or leverage aversion. In any case, it doesn't seem obviously consistent with consumption smoothing. This labor income effect we also think is interesting. Even though it's very temporary, there is kind of a large income effect, which is not just coming from total income, it's actually coming from labor income. We also find a little bit of evidence for increased labor force participation. So some of that labor income effect comes from an additional person in the household entering in the workplace. Some of it comes on the intensive margin, where people maybe work more hours, or maybe there's more kind of less black market labor supply, more regulated labor supply, maybe because they need to qualify for a mortgage in that year. But in any case, that's an interesting finding as well. So then returning to the effects post-privatization, right? So here, this is basically the 4 years after that initial year of homeownership. What we're seeing is effectively a very weak consumption response. It's about 8,000 krona per year for the next 4 years, but it's not statistically different from zero, okay? And that number actually hides a big cross-sectional difference, heterogeneity, between two groups of treated households. Those who end up staying in their apartment for as long as we can see them, and those who end up moving away and going elsewhere. The stayers barely change their consumption at all, only 10,000 krona over the next 4 years combined, whereas the movers consume 100,000 krona over the next 4 years. Right? So to the extent that we're seeing a consumption response, it's coming from the guys who are moving away. Now, obviously, you may say that's an endogenous choice whether to stay or move. So this also, by the way, holds if you look at the probability of moving based on predetermined characteristics as of the year before the experiment took place. So this points to the importance of actually realizing that windfall, that capital gain for the consumption response. The stayers, they don't realize that gain. They have the gain, they could easily borrow against it, but yet they choose not to. Okay? What they do instead is just gradually pay off their mortgage, and they behave like this kind of forced savings benefits type of individuals that we have, that we associate with homeownership. In contrast, the movers are tapping into their housing wealth. They're consuming out of this realized windfall. So there's something about the realization of this windfall that seems to drive consumption behavior. So the fact that there is this windfall is also an opportunity for us, because it allows us to estimate the marginal propensity to consume out of housing wealth. Now, this marginal propensity to consume out of housing wealth, there's an entire literature on this. The key problem with this quantity is that it's an endogenous quantity, right? Because consumption and housing wealth are driven by the same kind of variables. It's actually very hard to make much out of those MPC estimates in most of the prior literature. What's different here is that we have an exogenous shock to housing wealth, which is random, and so which is really truly exogenous variation in housing wealth. And so we can, the numbers that, so basically what we do is we look at the consumption response after this privatization experiment relative to the size of the windfall. That's our marginal propensity to consume estimate. And overall, for the whole sample, we find that it's 2.1%. This is a very small number. To put that in perspective, if you had a complete markets permanent income hypothesis type world, then essentially that MPC would be related to the discount rate, right? So it'd be like you need a 2% time discount rate to explain a 2% MPC, right? So it's possible, but it kind of requires a certain set of assumptions. In contrast, there's a lot of new evidence from the financial crisis in the US, for example, by Mian and Sufi and Berger et al., and Kaplan and Violante, that estimates this quantity and estimates it to be an order of magnitude larger, like 20% or something like that, right? So that kind of raises the question of, to what extent is this sample specific, or to what extent is this just because that's not fully picking up exogenous variation in housing wealth. And importantly for us, there's this large heterogeneity in this MPC between stayers and movers. Next, we turn to the housing collateral effect, which I think is one of the more interesting findings in the paper. And so we asked, do homeowners and renters respond differentially to a similar income shock? And do owners use their debt capacity to smooth consumption? And so what we're going to do here is we're going to look at the group of people who suffers a more than 25% decline in their labor income. So this could be one of the two households loses their job, for example. And then we're going to see is the response. So now we're going to compare two people whose household each suffers a 25% income drop. One of them randomly got to buy their house, the other randomly didn't. Do they respond? Is their consumption responding differentially? And we find that it very much is. To such an extent that the entire drop in labor income is offset by essentially increased borrowing. Okay? And so owners respond very differently to income shocks than renters. And to the extent that we found a positive consumption response post-privatization, it's essentially driven by the subgroup of people who gets a negative income shock. Okay? And that's true both for the treated stayers as well as for the treated movers. We look at stock market participation. In the interest of time, let me just very briefly point out that homeownership increases stock market participation by about 3 percentage points on a base of 50 percentage points, and the fraction of assets invested in risky asset stocks and mutual funds by about 3 percentage points. And so overall, there's substantial effects. These effects are consistent with a story where the increase in home equity is actually kind of making households wealthier and effectively less risk averse, which is the argument made in a paper by Chetty, Center, and Zeidel in the JF. And finally, we study mobility. I think we find very strong mobility effects, very strong increases in mobility from home ownership, whereas mobility between zip codes is about 4% before privatization, it essentially doubles after privatization. We argue in the paper quite at length that this evidence for differential mobility is not driven by somehow the renters in Stockholm being unusually immobile, but instead that it suggests kind of this housing ladder, evidence for this housing ladder hypothesis. Okay? In the interest, unfortunately, I'm out of time. We also look at variation across windfall in all of these effects. The main finding here is that our effects are largely intercept effects in the sense that they hold even for people who got only a very small windfall. They're fairly similar across these different windfall bins. So to conclude, we have a unique setting to better understand the impact of homeownership on individual behavior. As long as home equity gains are not realized, we find that effects on consumption are small, unless households are hit with a negative income shock. The savings benefits of homeownership are there, including a higher risky share. So people can take advantage of the home equity, of the equity risk premium. Second, we find that realized home equity gains do increase spending. They also promote mobility, hard work, and higher stock market participation. We have a new set of MPC estimates and strong evidence for the housing collateral effect. And on balance, we would conclude that we're finding more evidence for the positive view of home ownership. Thank you very much.